Good morning, good afternoon, everyone. It's Ankit, whenever or wherever you're watching this video. Thank you for taking time out of your busy schedule to watch today's video. I hope everyone's having the best day or the best week of their life. Today, I just want to do a short video about 3 profitable indicators that I use, and you can use them too, to make you some profit and start getting some winning plays in your portfolio. Leave a comment below with what your favorite indicators are and why. Let's try to hit 3,000 subscribers in 3 months. With all that out of the way, let's get into today's video and talk about these 3 profitable indicators that I use. And soon enough, you'll probably be using them too. So what is the EMA? The EMA is simply a moving average that places a greater weight and significance on the most recent data. And as the graph keeps moving forward, the data points constantly update as the new moving average. So as you can see in this little graph right here, as you keep moving forward, it's going to constantly update the data points. Here's the formula to calculate the EMA, or the moving average. So the best moving averages are the 20 EMA, its pullback and support, the 50 EMA, middle price, the 100 EMA, big price dip, and the 200 EMA, value zone. I'm curious on which one you prefer on your charts. Let me know in the comments below. The next indicator I love to use is volume weighted average price, VWAP. Volume weighted average price helps on security averages price over a time frame or a trading period. So if you bought a stock lower than the price for the VWAP, then you're going to be happy. But if you bought a stock that's higher in the VWAP, then you won't be happy because you're losing money. So let's say you have 3 people that are buying a stock. One bought at $10, one bought at $8, and another one bought at $11. The VWAP is $9.33. Let me know in the comments below which one you think won the trade. Is it the $10, $8, or $11? The answer is the person who had $8, because their price is lower than the VWAP. Here's the formula for VWAP, and here's how to calculate it. And the last indicator we're going to talk about is how to use the RSI indicator, which gives you the overbought, the RSI line, and the oversold area, which is the bottom part, and the overbought part is on the top. The RSI stands for Relative Strength Index. The standard setting for the RSI is 14 periods. This means the value of the indicators is based on the 14 candles. The RSI evaluates how many of those 14 candles were bullish or bearish. The size of the 14 candles and generally tries to measure the momentum of the price. So if you see the RSI getting close to the 100, that means it's in the overbought area. When the last 14 candles were closely or mostly bullish, the value is getting close to 0, that means it's oversold. When the last 14 candles were mostly bearish, the RSI value is close to 50 in the middle. When the average gain or loss of the last 14 candles were equal, remember, just because you have the RSI, it doesn't mean that it's indicating buy or sell single. Overbought and oversold RSI values are simply a sign of price having a current strong momentum, therefore might pull back or even reverse soon. However, there's no guarantee of what can happen in the future. RSI should be used as an additional help, and the context always needs to be considered, especially the current trend direction, the time frame, and the asset play an important role